Good morning and welcome to TOITOI Japan Market Radio, coming to you from Tokyo on Saturday, January 4, 2026. I'm your host, and this is your daily briefing designed specifically for global investors tracking Japanese markets. Today we're going to dive into some significant geopolitical developments that are shaping sentiment around the region, even though Japanese markets were closed for the holiday.
Thanks for having me. Yes, the Japanese market was closed today for the holiday, so we don't have any trading data to report on the Nikkei 225, TOPIX, or movements in USD, JPY. However, there's been plenty happening on the geopolitical front that will likely influence how markets reopen, particularly around US-China tensions and what that means for Japan's strategic position in the region.
Let's start with what's been dominating headlines over the weekend. We've seen a U.S. military strike on Venezuela, and analysts are now assessing what this means for China's regional ambitions, particularly around Taiwan. How should investors be thinking about this?
This is a really interesting dynamic that matters a great deal for Japan. What happened is that following the U.S. strike on Venezuela, geopolitical analysts are trying to gauge whether this signals a broader willingness by Washington to use military force, and more importantly, whether Beijing might interpret this as a green light to pursue its own territorial claims more aggressively. The consensus view right now is that while China might feel emboldened, an imminent military attack on Taiwan remains unlikely in the near term.
So we're talking about elevated rhetoric rather than immediate military escalation. But why does this matter so much for Japan specifically?
Japan has direct exposure to China's territorial assertiveness through competing claims in the East China Sea, particularly around the Senkaku Islands. Beyond that, any shift in U.S. willingness to use military force, or even just perceptions of that willingness, affects the credibility of U.S. security commitments that underpin Japan's entire defense posture. Additionally, heightened U.S.-China tensions create significant unpredictability for Japanese supply chains and regional trade flows, which are deeply integrated with both economies.
Let's break down the market implications when trading resumes. Starting with equities, how do you see this playing out for the Nikkei and TOPIX?
It's a mixed picture for Japanese equities. On one hand, cyclical exporters and defense contractors could actually benefit from an increased geopolitical risk premium and potential uptick in defense spending. We've seen this pattern before when regional tensions rise. On the other hand, tech and semiconductor stocks could face headwinds if China responds with economic retaliation or supply chain disruptions. Overall, I'd say the impact is likely to be limited given that the assessment is Taiwan attack unlikely, which reduces tail risk fears.
So not a panic scenario, but definitely something to monitor. What about the yen?
We could see modest yen strength as a safe haven currency in risk-off scenarios. However, the muted military threat assessment may cap any significant appreciation. The yen typically benefits when investors flee to safety, but if the consensus remains that immediate conflict is unlikely, we won't see the kind of sharp moves that would come with a genuine crisis.
And on the rate side, any movement expected in JGB yields?
Yields are likely to remain stable. Much of the geopolitical premium is already priced in at this point. If anything, yields may drift lower if global risk sentiment deteriorates further, which would support JGB demand as a safe asset. But I wouldn't expect dramatic moves unless we get a significant escalation beyond current rhetoric.
Staying with the geopolitical theme, there's been notable activity on Chinese social media that's worth discussing. Chinese commentators have been seizing on the U.S. approach to Venezuela's Maduro regime, suggesting it could serve as a template for U.S. policy toward Taiwan. This seems to be amplifying concerns.
Exactly, and this is where the narrative becomes particularly important for markets. What's happening is that Chinese social media users and some commentators are reframing recent U.S. actions regarding Venezuela, specifically around regime change and diplomatic non-recognition, as a potential precedent that could be applied to Taiwan policy. Beijing appears to view this as a model worth highlighting.
That sounds like it ratchets up the pressure considerably. Why should Japan-focused investors care about this narrative shift?
This signals escalating geopolitical risk around Taiwan, which is absolutely critical for Japan for several reasons. First, there's proximity and supply chain exposure. Taiwan is essential to Japanese semiconductor and electronic supply chains. Second, Taiwan's status directly affects stability in the East China Sea and impacts Japan's own security calculations. Third, any shift in US-China dynamics over Taiwan could pull Japan deeper into great power competition, given its security alliance with the United States. And finally, Japan may need to recalibrate its own Taiwan policy and military posture in response.
Let's talk market impact from this specific development. Are we looking at different effects compared to the Venezuela strike discussion?
There's overlap, but the Taiwan framing adds another layer. For equities, we're looking at negative pressure from an elevated geopolitical risk premium that could weigh on overall sentiment. Semiconductor and tech exporters face particularly acute supply chain uncertainty given Taiwan's central role in that ecosystem. For the yen, we'd likely see yen strength in a risk-off environment, though sustained US-China tensions could complicate the traditional safe haven dynamics. And for JGB yields, we'd expect downward pressure from flight to quality buying of Japanese government bonds.
So the safe haven trade becomes the dominant theme if this escalates. What should investors be watching for as concrete signals?
Watch for escalating Taiwan rhetoric from Beijing and any US policy clarification on Taiwan recognition. Those would be the key indicators that this is moving from social media commentary into actual policy shifts. Until then, it's priced as elevated risk rather than imminent crisis.
Shifting back to broader market dynamics, there's been analysis of how US stocks performed throughout 2025, significantly outperforming international markets. This has implications for Japanese asset allocation, doesn't it?
Absolutely, and this is a structural issue that Japan has been dealing with for some time. What happened is that US equities significantly outperformed international markets throughout 2025, extending the relative strength of American stocks that has characterized recent years. This matters enormously for Japanese capital flows.
Walk us through why this US outperformance creates headwinds for Japan specifically.
There are several channels. First, sustained US outperformance perpetuates what we might call the reverse Japan rotation trade, where global investors, including Japanese institutions, continue to favor US exposure over Japanese equities. Second, a strong US equity market environment often correlates with the Fed maintaining rates at higher levels, which affects relative yield differentials between US Treasuries and JGBs. Third, Japanese exporters face continued headwinds from relative valuation disparities, as international capital favors US tech and growth stocks over Japanese cyclicals and value stocks.
So even with strong domestic fundamentals in Japan, the capital is flowing elsewhere. What does this mean for each market segment?
For the Nikkei and TOPIX, it represents a potential headwind from continued capital rotation to US markets, which limits upside momentum despite whatever domestic fundamentals might justify. For the yen, it creates persistent downward pressure as the US rate premium incentivizes carry trades and reduces demand for yen-denominated assets. And for JGB yields, we may see upward pressure if global yield competition intensifies, since widening USD/JPY yield spreads could attract further capital outflows.
It sounds like the BOJ's policy path becomes even more critical in this environment.
Precisely. The bottom line is that continued US market dominance reinforces structural headwinds for Japanese equities and the yen, despite Japan's own strong corporate earnings backdrop. The BOJ's eventual normalization path becomes more critical to rebalancing relative valuations and making Japanese assets competitive again on a global stage.
Let's bring this together for our audience. What are the main themes global investors should be tracking as Japanese markets reopen after the holiday?
3 key themes. First, geopolitical risk around Taiwan and broader US-China tensions, which creates both safe haven demand for the yen and JGBs but uncertainty for equity sectors exposed to supply chain disruption. Second, the structural challenge of US equity outperformance and what that means for capital allocation away from Japan. And third, watching how the BOJ navigates policy normalization in this environment, which will be critical for reversing some of these capital flow dynamics.
All critical factors for anyone with Japan exposure in their portfolio. As always, we're not here to give specific investment advice, but rather to help you understand the forces shaping these markets. If you're a global investor tracking Japanese markets regularly, consider subscribing to stay updated on these daily developments. Thanks for joining us on TOITOI Japan Market Radio.
Thank you.